If you are planning to claim your OAS or CPP in the next few years, stop everything you are doing right now, because there are 4 specific accounts sitting in your name right now that could cause CRA to tax away up to 85 cents of every dollar you earn in retirement. And the worst part is, most Canadians have no idea this is even happening to them until it is already too late. And today, I am going to show you exactly which 4 accounts you need to empty before you ever touch that OAS or CPP button, because this one decision alone could save you or cost you tens of thousands of dollars over your retirement lifetime. Why this matters in 2026. Here is what is happening in Canada right now in 2026 that makes this more urgent than ever before. CRA has not changed the OAS clawback threshold dramatically. It sits around $9,997 for the 2026 income year. But what has changed is that more Canadians than ever before are walking into retirement with bigger RRSPs, larger defined contribution pension balances, and more non-registered investment income than any previous generation. And that combination is lethal when you start layering OAS and CPP on top of it. The federal government is also watching retirement accounts more closely, and any mandatory RRIF withdrawals that kick in at age 71 are now pushing thousands of Canadians over that clawback threshold without them even realizing it. We are also seeing provincial tax rates staying elevated, which means the stacking effect of federal tax, provincial tax, and OAS clawback together is creating effective marginal tax rates that would shock you. So whether you are 58 years old planning ahead or 63 years old getting close to that CPP decision, what you do with these 4 accounts in the next 2 to 5 years will define how much money CRA takes from you for the rest of your life. The 4 accounts you must empty before claiming OAS CPP. Now let us get into the 4 accounts, and I want you to think about this carefully because each one of these creates a different type of tax problem when combined with OAS and CPP income. The first account is your RRSP, your Registered Retirement Savings Plan. This is the big one. Your RRSP is essentially a ticking tax bomb sitting in your portfolio. Every single dollar inside that RRSP has never been taxed, and CRA is waiting patiently to collect. The mistake most Canadians make is they let their RRSP grow until age 71. It converts automatically to a RRIF, and then the mandatory minimum withdrawals pile on top of their OAS and CPP income and push them straight into clawback territory. The strategy here is to start drawing down your RRSP in your late 50s or early 60s before OAS and CPP begin, so you are pulling that money out at a lower tax rate and shrinking the future RRIF bomb. The second account is your RRIF, your Registered Retirement Income Fund. If you are already past 71, your RRSP has already converted. The RRIF forces you to take minimum withdrawals every year based on your age, and those percentages increase every year as you get older. In your early 70s, the mandatory withdrawal rate might seem manageable, but combined with CPP and OAS income, it can very quickly push your total income well above $90,997 and trigger the clawback. Many people do not realize they can take more than the minimum from their RRIF in years before CPP and OAS start to reduce the future damage. The third account is your non-registered investment account. This is your regular brokerage or investment account that holds stocks, mutual funds, ETFs, GICs, or savings outside of any registered shelter. The income from this account, dividends, interest, and capital gains, gets added directly to your taxable income every single year. And if you are pulling OAS and CPP at the same time, that extra investment income can silently push you into clawback without you seeing it coming on a monthly basis. You typically only find out when you file your taxes and CRA sends you the OAS recovery tax bill. The fourth account is your Defined Contribution Workplace Pension or Group RRSP from your employer. A lot of Canadians in their late 50s have these sitting from past jobs, and they forget about them entirely. These accounts follow the same rules as RRSPs, fully taxable on withdrawal. And if you leave them untouched until you are also collecting OAS and CPP, you are going to stack income in the worst possible way. The strategy here is to begin converting and drawing from these accounts in a planned, strategic way during the gap years between when you stop working and when you begin government benefits. How CRA can tax you up to 85% if you don't empty them. Now I want to show you the exact math on how this 85% figure is real. Because when I say CRA could take 85 cents of every dollar, most people do not believe me until they see the numbers laid out clearly. Here is how the tax stacking works in Canada in 2026. Let us say you are a 72-year-old Ontario retiree. You are receiving CPP of $900 per month. That is $10,800 per year. You are receiving maximum OAS of roughly $8,800 per year. You also have a RRIF mandatory withdrawal of $30,000 per year. And you have non-registered investment income of $15,000 per year. Your total income is approximately $64,600. Now, in this scenario, you are actually okay. You are below the OAS clawback threshold, and your effective tax rate is manageable. But now let us say your RRIF is larger, and the mandatory withdrawal is $60,000 instead of $30,000. Suddenly, your total income jumps to $94,600. You have now crossed the OAS clawback threshold of $90,197. For every dollar above that threshold, CRA claws back 15 cents of your OAS. But here is where the stacking gets brutal. At that income level in Ontario, you are also paying approximately 43 to 46% in combined federal and provincial marginal tax on each additional dollar. Then you add the 15% OAS clawback on top of that marginal rate, and you are now looking at an effective marginal rate of 58 to 61% on dollars earned in that clawback zone. But it gets worse. If you are also triggering the age amount credit phase-out and losing other income-tested benefits like the Guaranteed Income Supplement or provincial drug benefit programs, the real economic cost of each additional dollar of income in retirement can climb to 75, even 85% when you add up everything you are losing. CRA does not advertise this. It is buried in the interaction between multiple tax and benefit systems, and most financial advisors only look at marginal tax rates without accounting for the full benefit clawback picture. This is exactly why emptying these 4 accounts before your OAS and CPP begin is not a nice to have. It is the single most important tax planning decision of your entire retirement. The best order and strategy to empty these accounts. So now that you know which accounts are the problem and why, let us talk about the exact order and strategy you should be following, because the sequence matters just as much as the action itself. Step 1. If you are between 55 and 65 and you have not started OAS or CPP yet, this is your golden window. These are the years where your income is likely at its lowest since you stopped working, and every dollar you pull from your RRSP or RRIF or defined contribution pension in this window is taxed at a much lower rate than it would be later when benefits stack on top. You want to be deliberately withdrawing from these registered accounts every single year during this gap to reduce their size before mandatory withdrawals and government benefits begin. You are essentially prepaying tax at a bargain rate. Step 2. Consider whether delaying CPP and OAS strategically makes sense for your situation. If you delay CPP to age 70, you receive 42% more than at age 65. But if your registered accounts are so large that mandatory RRIF withdrawals are going to push you into clawback anyway, then sometimes taking CPP earlier while aggressively drawing down your RRSP in the same years gives you a lower overall tax result. There is no one-size-fits-all answer here, but the math needs to be done before you make this decision. Step 3. Once you identify your target income level for each year of your retirement, fill from your non-registered account last. Your non-registered account, because it triggers annual tax on dividends and interest regardless of whether you withdraw, should ideally be the account you draw from only after your registered accounts are appropriately sized down. Move income-producing assets inside your TFSA wherever possible to shelter that ongoing income from CRA. Step 4. Use your TFSA as the final buffer. Your TFSA is the only account where withdrawals do not add to your taxable income, which means it does not affect your OAS clawback calculation at all. If you need extra cash in retirement and you do not want to push your income above the clawback threshold, your TFSA is where you pull from. This is why building your TFSA balance aggressively before retirement is so critical. It gives you a tax-free income tap that CRA cannot touch. Real Canadian examples and numbers, 2026 rules. Let me give you two real-world Canadian scenarios using 2026 numbers so you can see exactly how this plays out in practice. Scenario 1. Meet Patricia, a 68-year-old retiree in British Columbia. She retired at 63 and did nothing with her RRSP during those 5 years. Her RRSP converted to a RRIF at 71 and now forces a minimum withdrawal of $52,000 per year. She also collects CPP of $9,000 and full OAS of $8,800 annually. Her total income is $69,800. She stays just under the clawback threshold. Her average federal plus provincial tax rate is about 24%, and she keeps her full OAS. She planned well and saved herself approximately $14,000 per year compared to retirees who let their RRIF grow unmanaged. Scenario 2. Meet Robert, a 71-year-old retiree in Ontario who did not draw down his RRSP at all before retirement. His RRIF minimum withdrawal is $85,000 because his RRSP grew to $1.1 million. Add CPP of $11,000 and OAS of $8,800, and his income is $148,000. He is $13,803 above the clawback threshold. CRA claws back $2,070 of his OAS. His marginal tax rate on those dollars above the threshold is approximately 53.53% in Ontario. He is effectively paying 68% combined on every dollar in that clawback zone. Over a 20-year retirement, Robert will pay an estimated $180,000 to $220,000 more in taxes than Patricia, not because he earned more, but purely because of account withdrawal timing. What you should do right now. Here is your action plan, and I want you to write this down or screenshot this right now. First, find out exactly what your RRSP and RRIF balances are today and project what the mandatory minimum withdrawals will look like at age 71, 75, and 80 using the CRA RRIF withdrawal tables. These are publicly available on the CRA website. Second, calculate what your projected CPP and OAS income will be using the My Service Canada account online. This takes 10 minutes and gives you a personalized estimate. Third, model your total retirement income picture by stacking all income sources together and checking whether you will be above or below the $90,997 OAS clawback threshold for 2026. Fourth, if your stacked income is going to cross that threshold, begin strategic RRSP or RRIF withdrawals immediately, even if you are still working part-time, to reduce the registered account balance before government benefits begin. Fifth, book a meeting with a fee-only financial planner who specializes in retirement decumulation, because this is not a DIY spreadsheet situation. The interactions between CPP, OAS, RRIF, provincial tax, and clawbacks require a proper retirement income plan, and getting this right is worth thousands of dollars a year for the rest of your life. Here is the final truth that CRA will never put in a brochure, and your bank will probably never explain to you clearly. The biggest tax bills in Canadian retirement do not come from earning too much money. They come from withdrawing the wrong money at the wrong time in the wrong order, and most Canadians only discover this mistake after they have already claimed OAS and CPP, and it is too late to undo it. The four accounts we talked about today, your RRSP, your RRIF, your non-registered investments, and your defined contribution workplace pension, these are the accounts that will define whether CRA takes 25% of your retirement income or 85% of it. And the only difference is the strategy you put in place before that first OAS check arrives. If this video helped you see something you did not see before, share it with someone you know who is approaching retirement right now, because this information could literally save them tens of thousands of dollars. Hit subscribe because every week we are covering exactly these kinds of retirement tax strategies that the big banks do not explain. And drop your question in the comments below. What is your biggest worry about OAS clawback? Because I read every single comment, and I may make your question the topic of the next video.